Nvidia has been one of the most talked about stocks in the market, and for good reason. But the real question investors are asking now is simple. Is Nvidia still a buy from here? In this video, I'm breaking down Nvidia's most recent earnings report. Take a look at the charts, discuss the three biggest risks to the business, and I'll give a one-year price target for the stock. Let's generate alpha. Here are the headline results. Nvidia just crushed earnings with massive numbers. Nvidia reported record revenue of $68.1 billion for the fourth quarter. That's up 73% year over year. This was well above analysts' expectations, and it marks one of the largest quarterly revenue achievements in the company's history. The company's data center segment, which includes AI processors and related hardware, generated approximately $62.3 billion in revenue this quarter, also a record and up 75% year over year. This highlights how AI infrastructure demand remains the dominant driver of Nvidia's business. Nvidia didn't just grow sales, it grew profits too. Earnings per share came in at $1.62, nearly double what it was a year ago. Net income climbed to around $43 billion, also almost double from the same quarter last year. Gross margins improved slightly to 75%. Those kinds of profit figures are amazing for a single quarter and show how lucrative Nvidia's AI-heavy growth trajectory has become. In commentary around the earnings, the CEO emphasized that we're essentially at a turning point in AI computing, with demand for advanced chips continuing to accelerate as enterprises and cloud providers build out next-generation AI infrastructure. Despite these blockbuster numbers, shares of Nvidia actually fell after the earnings release, as investors digested valuation concerns and broader market volatility. This shows just how high expectations are. Even great results aren't always enough to send the stock higher in the short term. Let's take a look at the charts. Nvidia is trading below both the 50-day and 200-day moving averages, which is typically bearish in the near term because it suggests the stock is in a pullback phase relative to its intermediate and long-term trend lines. Notice the 50-day is still slightly above the 200-day. That usually implies the bigger picture trend had been up, but price has recently weakened enough to slip under both key averages. A relative strength index under 30 is commonly considered oversold. At 27, Nvidia is in that oversold zone, which can set up short-term bounce potential. But oversold doesn't automatically mean the bottom is in. In downtrends, RSI can stay oversold longer than people expect. The more reliable shift is when RSI starts making higher lows while price stabilizes, then price reclaims key moving averages. Keep an eye on the moving averages. A pushback above the 50-day and 200-day is a stronger confirmation that momentum is improving. Here are three of the biggest risks that could meaningfully impact Nvidia. Nvidia's growth is heavily tied to continued high capital expenditure on AI infrastructure from hyperscalers like Microsoft, Google, Amazon, and Meta. If these major tech customers slow their AI investment or reduce spending, Nvidia's revenue, especially its data center business, could suffer significantly. Nearly all of Nvidia's revenue growth hinges on continued demand for AI chips. A pullback in CapEx due to economic tightening or shifting priorities could materially reduce future sales expectations. Nvidia faces rising competitive pressure on multiple fronts. Traditional rivals like AMD, Intel, and other chip makers are aggressively innovating in AI and data center hardware. Hyperscalers are also building their own AI accelerators, which could reduce reliance on Nvidia's GPUs. Even if alternatives aren't yet as powerful, broader adoption could erode Nvidia's pricing power and margins over time. Nvidia derives a significant share of revenue from international markets, notably China, which has been hit by export restrictions and regulatory scrutiny. U.S. export controls limit sales of advanced chips to China. Broader U.S.-China tensions could disrupt supply chains, approvals, or future sales growth. These factors could materially influence revenue, margins, and investor sentiment going forward. Now, the big question: where could the stock go from here? Most analysts maintain a strong buy rating with an average price target of about $263. Looking at the discounted cash flow model, the base case estimated value for the stock is $220 to $250 per share, and the best case is $350 to $400 per share. Please keep in mind that DCF is highly sensitive to assumptions. Even small changes to growth or discount rates can swing the fair value dramatically. As for my opinion, I am giving Nvidia a strong buy rating with a one-year price target of $350. Here are 3 reasons why I believe it's a buy, especially for long-term investors. Nvidia is the backbone of the AI revolution. Nvidia isn't just participating in AI, it's powering it. Its CPUs and GPUs are the standard for running artificial intelligence models used by companies like Microsoft, Amazon, Google, Meta, and OpenAI. When companies spend billions building AI data centers, Nvidia is often the first call. What makes this powerful is that AI spending isn't a one-time event. Models need to be retrained, scaled, and upgraded constantly, which creates recurring long-term demand for Nvidia's chips. Nvidia has something very few companies achieve: true pricing power. Its advanced AI chips are in such high demand that customers are willing to pay premium prices, sometimes months in advance, just to secure supply. That demand translates into industry-leading profit margins, which give Nvidia enormous flexibility to reinvest in R&D and stay ahead of competitors. Nvidia's balance sheet is rock solid. The company generates enormous free cash flow, holds strong cash reserves, and has minimal debt relative to its earnings power. That financial strength allows Nvidia to invest aggressively in innovation while also returning value to shareholders. This financial strength allows the company to do share buybacks and pay a dividend. Nvidia has clear long-term visibility. AI adoption is still early, data center demand continues to expand, and new applications, from autonomous systems to healthcare and robotics, are only just getting started. So when you put it all together, Nvidia's dominance in AI infrastructure, its unmatched pricing power, and its strong financial foundation, it's easy to see why many investors still view Nvidia as a long-term buy. That doesn't mean the stock won't be volatile, but for investors focused on the future of technology, Nvidia remains one of the most compelling opportunities in the market. Thanks for watching. If you enjoyed this video and want more earnings recaps with one-year price targets, please like and subscribe. Until next time, keep earning, keep saving, and keep investing. I own Nvidia shares through an ETF. This is not financial advice, just my personal opinions. Make sure you consider your own risk tolerance, time horizon, and financial situation before making any investment decisions.